Hi, welcome to DASAR. My name is Darshan, and we have an awesome podcast with Devang Kabra today. We are going to talk about investing, about making money. Just a quick overview. Devang is someone who has turned from an entrepreneur to an investor. Through childhood, he's burnt a lot of his own money in trading, in investing, and then over the last 2 or 3 decades, he's gone on to learn and read and practice what he's been preaching by following and testing different ways of investing in order to make money, right? So in this podcast we cover futures and options. What are futures, what are options, when does it make sense for a person to invest through these investment vehicles. We talk about the stock market, we talk about direct investing, we talk about mutual funds. How do you select out of the hundreds of various mutual funds out there. We talk about cryptocurrencies, and Devang, in his own style, in a very candid way, shares his own experience. And lastly, we talk about how Devang has, what are some of the key lessons and contradictions and the myths that are there in the investment world. And so he tries to debunk a few of those myths for us. Take a look at this podcast. If you are interested, reach out to us. We'll be happy to include your questions in the future podcasts on personal finance, financial independence, and investing.
To start off with, my first stock buy was way back in 1998 when I was in the 12th standard, and I bought a share called Satwana Ispat for 12 bucks. I borrowed 12,000 rupees from my mom, and I just got a. I was sitting in the library in NM College in Bombay, where I've graduated from, and there were a couple of people talking about Satwana Ispat, बहुत अच्छा stock है, ऊपर जाएगा, ले लो. So I went on the basis of that. I don't even know who told me. I don't even know what the discussions were. I mean, who was talking to whom. I just overheard. I went home. I told my mom, lend me 12,000 bucks. My pocket money was 550 per month that time. So I said, lend me 12,000 bucks. I will guarantee मैं वापस कर दूँ profit करके. And obviously I blew it up. So that was how I started to, so from 98, 99 till today, I've done all kinds of things. So whatever I'm presenting, you can be rest assured that I have done everything: futures, options, leverage trading, commodities. So I have traded in the market, traded and invested in the market when you could get a 10 lakh rupee future lot for a 50,000 rupee margin when the future started in 2006-7. So I've done long term, short term, mid term, whatever you call it. I've done all that, and based on, and I've blown up my account. I don't know. I don't even have the count now. Maybe 3 or 4 times my own account I've blown up, and now God's grace, with the help of the learnings which I've got over the period of time, I've kind of I can call myself a very mature and a stable investor right now. Telling in the course of this talk, I will tell you few things which are completely contradictory to what you might have heard about. Right? So, first thing, which is a contradictory thing, is you get more ROI with lesser risk in delivery-based trades compared to futures or leverage trades, futures, options. This is completely contradictory to whatever people, the big brokerage houses like Zerodha would tell you, or all the trainers which are around the market would tell you. Everyone would tell you, okay, because you get the leverage, you will earn more. But the fact is, because you have the leverage, you will also risk more, right? In simple terms, futures trade is nothing but it is leveraging on your trade. Suppose you've got 2 lakh rupees in your bank. You buy a contract, futures contract worth 6 lakh rupees, keeping that 2 lakh rupees as a margin. That is what futures trading is all about. It is trading on leverage. In delivery trading, it's very simple. You've got a crore. You can buy only 1 crore rupees worth of shares. In options and futures, if you have a crore worth of shares or cash, whatever it is, you can go and buy 3 crores worth of contracts, which you can sell at a future date. That is what is futures. Options is something more complicated. Let's not get into that. But options is also one form of leverage trading where you don't have the actual stock in your hand, but you have the right to buy or right to sell. Intraday may, you buy and sell on the same day. You buy for 10 rupees, try to sell for 12 and whatever it is, and you get a certain return on your capital. So now the drawdown on capital is the risk. Suppose if you are buying something at $100 and you are trying to sell it at 120 on the same day, the stock might also go to 80 or 90 on the same day. Now, if you are wanting to buy and sell on the same day, this is what the typical risk on capital is, 0.25% to 3%. And the potential IRR, this is the yearly return, which now all these figures are my figures. These are my experiences, my actual trades, which I have documented in my trading journal, and I've come out on the averages based on this. So this no one else can certify these figures but me. So it's the choice is on you whether to believe these figures or not, right? There is positional trading, which happens from 7 days till 3 months. You buy something, hold it for max 3 months. There, the risk on capital is 12 to 25%, and the return is 12% to 80%. You can get up to 80% return if few of your things work out very well. There is a swing trading, 3 to 12 months. Again, the drawdown on capital is 25%. The potential drawdown, potential risk is 25% on your capital. 12 to 80%, the same as the return potential. Now, long term is 12 months plus. 12 months plus going up till 5 years, 10 years. Rakesh Jhunjhunwala is holding Titan since 30 years, 35 years now. So 40 to 60% multiple times is the risk of your drawdown. Now, when people talk to you and tell you that you buy and forget, buying and forgetting means actually seeing your capital erode by 40 to 60% multiple times in your holding period. So that is the mentality which you need to carry to get this returns of 12% to infinity. So infinity is, again, giving an example of Titan, I will come to that much later again. It has given a CAGR of 40% per year, 40% CAGR, but it has given drawdowns of 29 or 30 times. It has given drawdown of 20% or more. 0.00001% of the people who do trading, who do leverage trading, are making money. 0.00001%. And if you think,
so 1 out of how many people are making money in trades?
1 out of a crore. 1 out of a crore. And this false hope is given by every trainer on earth that you are 1 out of that crore. But I'm telling you, you are not. It's as simple as that. The skill will come to you and your inner voice will tell you that, boss, I'm ready. But when will that happen? When you've made good money in your delivery trades and delivery investments. After that, something inside you will tell that I'm ready.
Maybe like calculus and advanced calculus.
So this is not based on any calculation. Trading and investing in equity markets is more of an art rather than a science. I'd like to make it very clear. And people are trying to put mathematics around the whole thing, and they are trying to systematize the whole thing. It cannot be. This market is not perfect because the market runs on emotions, and emotions are not governed by mathematics. The stock price moves only when there is a buyer and there is a seller. And why the buyer is buying and why the seller is selling, there is an emotional decision. Even if the buying and selling is happening based on an algorithm, the developer of the algorithm or the maker of the rules of that algorithm is a human being who's governed by emotions. So the stock market it's absolutely governed by emotions, which is the reason why you can have a math for sure, you should have, but to the extent of risk management and to the extent of broad-based rules. You cannot define your rules or your systems of trading to the T. There has to be discretion in this for sure, right? So this is a broad difference between delivery and leverage trade. So in delivery trade, in delivery trades, basically you're taking delivery. You have something, you are paying money, you get something in your demat account. In leverage trade, you just have a position. You can convert a short-term trade into a long-term trade, right? So this happens when you buy something for 100 and it goes for 90 and you don't want to book a loss, and you say, okay, fine, let it, वो उसको रहने दे, छोड़ देते हैं, बाद में देखेंगे, वो 90 का 80 होगा या 120 होगा, आगे की बात है. But then you can decide midway to change your strategy. Here in leverage trades, you always have to be short term. You cannot be long term. It's highly impossible to go long term if you are having a leverage trade, because as I told you, the fluctuation, even 20% fluctuation in price will wipe out 60% of your capital. So the power to stay on is not there if you're leveraging a trade. Time spent to see the markets is minimum. So if you're getting into delivery trade, it's okay. I mean, you can buy and forget, or you can buy and hold. You just have to see the prices once in the morning, once in the evening, and you're done with it. But if you're leveraging, you have to put, I mean, automatically your whole attention goes into seeing the market, seeing the prices, seeing the movement, and your attention, mind space, everything gets focused. Whatever you are currently doing as a full-time core focused activity, it gets completely defocused. You are completely defocused, and that's a huge price to pay for doing leverage trading. Forget the money. Even if you make money, this is a huge price to pay, because what you are primarily doing is getting disturbed. That has happened with me a number of times, and I cannot express it in words, because for example, imagine if you're giving 4 hours of your daily time in seeing the markets, just because you've done a leverage trade, and your chance to win is maybe 20,000-25,000 per contract. But then look at the time which you are spending. Your daily portfolio volatility is max 2%. If you have 15 to 20 stocks. Now, if you have 6 to 8 stocks where you are doing a very concentrated portfolio, your volatility will not go beyond 5%. This I'm talking on capital. Now, here you are having 6% to 15%, assuming you are having a 300%. So every day, if you've got a crore, you're seeing either 85 lakhs or 120. Next day again, 85 का 60 भी हो सकता है, 85 का 70 भी हो सकता है, कुछ भी हो सकता है. So on a daily basis, you have to see that volatility and sleep. So it's very tough to have a good night's sleep if you're doing this, right? And that is also, Darshan would have, I'm sure he would have told you, to have a good sleep, to have peace of mind is also a part and parcel of having financial freedom, right? So yeah, so this I am talking about drawdowns. I'm talking about, see, I'm just giving you these stats before because the questions, this itself will automatically answer the questions which Darshan has posed me, and it will later on come to you. Now Titan Limited, Rakesh Jhunjhunwala, marquee investment, $2 billion investment now it has become for him. Now he bought the stock when it was like single digit. Now this I've this I've got from the charts, this table. Now this is the summary. You have seen a 20 to 30% drawdown from top to bottom 16 times in 20 years. 16 times, 30 to 40%, 7 times, and 40% plus 6 times. So 16 times in 20 years. So at least once a year on an average, you are seeing your capital erode by 30%, 40%, and 40 plus. The highest being here, you can see the 61% in 2007 when the price was 88. So on a CAGR basis or on a mathematical model basis, the stock has given 38% CAGR from 2002 to 2022. But this CAGR has not come in a straight line. I'm trying to, if you can pay attention to this highlighted this thing, with 4 rupees starting from 2002, if I do a CAGR of 1.38%, 2005 में 11 रुपये होना चाहिए. Year 2005, the price was 10 rupees. So almost it's going in a linear CAGR in the way the mathematics is there. But now is where the mathematical models goes for a toss. In 2010, the price should have been 53 rupees, but this price was achieved in 2006 itself. So the price has run faster than the CAGR, than the calculated CAGR. 2014 191 होना चाहिए था, 2011 में ही कर दिया उसने ये price. 2019 955 होना चाहिए था. Now 2018 में हुआ 938. So now from 2011 till 2018, the CAGR movement of the stock was slower than your arithmetic calculation or straight line calculation. So the point I'm trying to put here is, I will also show this to you on chart after I end the presentation. That that chart will depict more about how you are about how you emotionally you have to tackle the drawdown. You can see this. The drawdown lasted for 373 days, 43% drawdown lasting for 147 days, 21% drawdown lasting for 14 days. Now, you have to understand, if the stock is taking 14 days to come down from 10 rupees, it will definitely take more than 14 days to go up. So, whenever you see the stock market, the stock price comes down faster at a faster, higher pace compared to when the price goes up. It goes up at a lower pace. So, whatever number of days I mentioned here, it is minimum double the number of days which is taking itself to come to this price, 53 bucks. If I'm talking about 35 days, it is taking more than 70 days for the stock to come up to this 53 rupees. Now you see this 210 days. So almost you're talking about a more than a year of zero returns. 126 days, 34% drawdown. 238 days. 238 days. Multiply that by 2 and see how many number of years you have to sit idle with the investment. This is the kind of patience and this is the kind of temperament which Rakesh Jhunjhunwala has, which maybe me and you don't have, and which is the reason why he's having those $2 billion. These are what I call the risk assets: equity, mutual funds, SIP, PMS, and investment advisor. So whether you entrust money to investment advisors, PMSs, you do SIP mutual funds, or you do directly in equity, these are all risk assets. कोई भी आपको कुछ भी बोले, म्यूचुअल फंड सही है, SIP करते जाओ, कुछ वहां रिस्क है. Let's understand that there is a risk because the money is flowing into the equity markets. What SIP and mutual funds do is they reduce the volatility for you. They reduce they act as shock absorbers because you're putting in money at every interval, at every price. So you just keep on putting in money, which reduces the volatility for you. Otherwise, the risk is there. So there are equity mutual funds, there are PMSs who have given negative returns also in certain years, and they have given stellar returns also in certain years. Then there are these index ETFs, financial ETFs, emerging markets. If you talk about beyond India, so there are emerging markets like other Philippines, Vietnam, Korea. अभी तो श्रीलंका पाकिस्तान तो उठ गया तो वो छोड़ दो. But all these markets are also very promising, where the so-called goras, we call FIIs goras in our parlance. तो गोरे लोग यहाँ सब पैसे लगा रहे. So then there are these new tech stocks, which are just recently, in the last 1.5 years, the Paytms of the world and the policy bazaars of the world have been, So these new tech stocks are, there is a different science to invest in new tech stocks, which is a completely different session altogether. But yeah, these are risk assets which have potential of giving you very high returns. The bond and the money markets are safe havens, supposed to be safe havens. Bond is again supposed to be safe haven, but it is no longer a safe haven anymore, because you see if you would have switched your equity mutual fund and switched some part from equity into the bond, you might be knowing what I'm saying, what I'm talking about. Gold, silver, platinum, palladium, and precious metals miners. So precious metals miners meaning, in India we've got Hindustan Zinc, which mines silver. We've got Hindustan Copper, which mines copper. Copper is a non-precious metal, but yeah. So Hindustan Zinc is one company, Vedanta is one company which has got certain certain portion of silver mining. So these companies, there are a plethora of such companies in the US. In fact, there are ETFs in US based on silver miners, gold miners. There are thematic ETFs in the US which only deal in the mining companies. There is the US dollar. Then real estate, which is supposed to be safe havens, or now we've got REITs, REITs. Then there are developed countries indices which are safe havens as per the textbook parlance, but they are actually not safe havens anymore. Then there is a defensive sector, for example, pharma, FMCG, PSUs, these companies which will be running, they will be selling products, irrespective of your recession, irrespective of your war or whatever it is. I mean, the business of pharma and FMCG will keep on running. Now, so now what the allocation should be? Now the allocation should be ideally, anywhere between 20 to 30% in the safe haven assets and 70 to 80% in the risk assets, depending upon what your comfortable level is. Again, as I told you, the markets are not signed. I cannot draw mathematics around it. It all depends upon what your current outlook about the markets, outlook about life in general, what currently you're earning, how much you're saving, what stage of life are you currently. But all in all, personal experience, except for gold, I don't have my personal money invested in any of the safe haven assets. Except for gold, everything else is in the risk assets. And gold is also not investment. Actually, we just make jewelry out of the gold, and the ladies of our house enjoy. So that's it. And this I cannot even sell, right? So this is something which is a buy and forget for us. Apart from that, as far as real estate is concerned, we've got a house and we've got an office. That's it. We don't own any other real estate. And again, my logic, I will come to you later. Now, whether you should invest directly or indirectly. Now, it all depends upon what stage of life you are in, how involved or how focused you are in your current profession. It depends upon that. What interest level you have with with the equity markets, whether you love equity markets or not. You have to love equity markets. You have to love seeing the prices, the fluctuations, the profits, the losses. You have to love to see the loss and make a journal, and then come back to the journal, go back to the drawing board and understand whether it's a long-term or a short-term investment. Understand where you went wrong and do the corrective action, and then have the patience to wait for 8 to 10 years till the time you get your, you get it of how to do it. So if you have that kind of passion, even on a part-time basis, you're perfectly okay to go direct. If that's not the case, it's better you focus on your current profession, earn money out of that, and do an indirect way of investing in the equity markets, which can be through mutual fund, SIP, investment advisory, PMS, whatever it is. So again, what risk you are willing to take? Now take it from me in writing. Safe asset or risky asset, कोई भी asset हो, कैपिटल का 50% तोड़ने मतलब देखने का तैयारी चाहिए कि ये 50% गया इसमें से, मैंने 100 रुपया डाला तो 50 रुपया जाएगा. मैं ये नहीं बोल रहा हूँ परमानेंटली जाएगा, बट you have to have the mentality to see many people. I mean, I've got many clients. So I've got clients who are into businesses. I've got clients who are professionals. I've got clients who are doctors. So many of these consulting kind of professionals, they have always spent their time, earned money. They have never seen a loss. They have never run a business where there is a chance of a loss or there is a risk, because they are skilled at something. They they perform certain services and they earn money. तो उनको लॉस देखना है ना, आदत नहीं है. और इसमें अचानक से if there is a 20% drawdown and they are like they go haywire, they go bonkers कि नहीं यार इतना लॉस कैसे हो गया. And on the other hand, people like me, हम तो एक्सपर्ट है लॉस करने में, तो हमको फर्क नहीं पड़ता है कि ठीक है 20% हुआ तो हुआ, क्या सीखने मिला वो पहले देखते हैं, right? So or a person who's into some trading business or who is into some manufacturing business, he has seen some losses. A first generation person who started a business on his own with a small capital, any business, and he's seen some. So he's got a different mentality and a different approach to see the losses, whether it's direct or indirect. So it all depends upon you. You have to take your call. The best, what I would suggest is that, or I would recommend is, if you cannot take out time from your current profession and you see yourself growing in your current profession, just stick to that, earn money from that, and let this money work for you, and do an indirect mode of investing. Start off with that. That will also, and suppose if you invest, I'm just giving a ballpark figure. Suppose आपने indirect investment के लिए 1 crore दिया, तो 10 lakh रुपया डायरेक्ट करो साथ में, and then you dabble around with that 10 lakh rupees and see see what you're good at, because you again have to do the trial and error. You have to do long term, short term, mid term, all kinds of investing, and then you will discover what you are good at after you start doing. So this investing directly is a long process. It's like a 5-10 year cycle where you are playing. It's like playing golf. You are playing golf and you are analyzing your own shots. You're playing against yourself. There is no opponent. So if you finish a hole in 3 shots, the next time you have to finish the same hole in 2 shots. You have to analyze and you have to do you have to understand how you should go about it. So this game you're playing with yourself. So only if you have that patience, you should go direct. Otherwise, it's better you go indirect. Now, whom to entrust your funds? That was one good point put up by Darshan. Now, one should choose a trustee of your funds if you can resonate with his thoughts and his personality. It's as simple as that. And this is very abstract. This is very right brain thinking. Now, if this is not, ideally, I would not choose HDFC because HDFC is the biggest name in the industry. I would not choose SBI because SBI is the biggest name in the industry for mutual fund. I would rather go, it's my hard-earned money. I would take the effort, dig deep, and understand who the fund manager of if I'm putting putting my money in a certain product, XYZ product, I should go dig and I should understand who the fund manager is for my particular fund. And I should get his track record कि वो fund manager क्या कर रहा है, because many times if you put money in HDFC, let's say for example Mr. Prashant Jain is managing your fund. Tomorrow if Mr. Prashant Jain moves to ICICI and your fund is still with HDFC, what happens? Then the discretion or the investment discretion of that funds lies in the hands of the new fund manager which has come in place of Prashant Jain. I'm just giving you a hypothetical example. So it's very important that you understand who the fund manager is, who is taking the decision to manage, to put in your funds. You should understand that, and I think that exercise is worth it because you're entrusting your hard-earned money. Now, how to assess the advisor? The worst method is to assess the advisor by looking at his returns. That's the worst method. This is again a contradictory statement which I'm making, but it is very, very true, and it has come out of experience. Now, I work with a certain strategy. I work with a certain discipline. Now, my strategy has given a 120% return in 2021, but it has given a 28% return in 2022. It has given a 40% plus 38% return in 1920. Now, these returns are different. My strategy is the same. So, every market condition is not good for the same strategy. For the same strategy, tomorrow I might give negative, I might give maybe 12%. I don't know. But the same market condition is not, advantageous to a particular strategy. Some market conditions are very good for long-term buy and hold. Some market conditions are good for trading. So looking at the returns, you really cannot assess whether the manager is good or not. How you can assess whether your fund manager is good or not is by the way Darshan is recording. I think you should, if the fund manager is pitching you on Zoom, or if the fund manager is pitching you personally, I insist that you record or make notes of what he's talking about, what his strategies are about, and then you go and you see whether he's implementing the strategies which he was selling you or not. The sales pitch should be the same as the execution. If I'm telling you I will buy and hold for long term, am I doing that? If I'm telling you I will buy only fundamentally good companies, if I'm telling you I will do only Nifty 500, and tomorrow if I go and buy something which is outside Nifty 500, I'm not following my discipline. That is, forget the returns. If I'm giving 100%, I've given 120% returns. It could be a fluke, right? But the point is, when you know that it's not a fluke, when whatever I'm saying, I'm executing the same. That you have to assess from the fund manager. And this is another it's a funny statement, but it will be good to check if your advisor or your fund manager is doing yoga, pranayama, or meditation regularly. this is funny, contradictory, whatever you call. I would just, this is very important for me, and this is very important for this discussion. So I would again like to have a show of hands. How many of us are doing yoga, pranayam, and meditation regularly? 1, 2.
So Devang,
Yeah.
one of the pillars of DASAR is peak fitness.
Okay.
Where that is, that includes meditation, that includes, yoga, that includes strength training. And so I'm very happy to hear this from you as well.
Yes.
But please do continue. I don't want to interrupt. I do want to keep a quick time check. We are at 8:50.
50,
Guys,
yeah,
I hope if you have any follow-up questions or if there's anything more, just interrupt Devang. All right?
Yeah, just
And
interrupt
shoot
me,
your
and
question.
I'm so passionate about it. I actually did not have a track of time. I was just going on. So if I'm boring you, just let me know, right? मैं तो रात बोल सकता हूँ पूरी रात, इसके कोई problem नहीं है. So yeah, yoga pranayam. Why the basic? I just tell you a basic premise. The basic premise of this is the screen in front of you, which shows the stock market prices. You see the chart, you see the screen, whatever it is. The same screen is being seen by Rakesh Jhunjhunwala. The same screen is being seen by me and you. सब लोग सेम स्क्रीन देखते हैं, सब लोग अपने अपने अलग डिसीजंस लेते हैं, seeing the same price, seeing the same screen. Your own fund manager will buy HDFC, another fund manager will sell HDFC after the announcement of the merger, right? So this is all the decision. And if you ask anyone, I'm sure you might have read that any big investor, biggest of his investments have come when he has, he's not taken more than 15 minutes to decide on the investment. Do you agree with me? I'm sure you might have read a lot of things. 15-20 minutes study kiya and decide kiya. Where does that conviction come from? It comes from consciousness. It comes from your, what the screen is telling you. It comes from understanding what the data in front of you is telling you and having the conviction to take the call and to stake your capital in it. Now, the point of doing yoga, pranayama, meditation is increasing the level of your consciousness so that you can perform better. It's as simple as that. Performing better, not only in the markets, in whatever profession you're doing, in your family life, social life, all, sports, everywhere. So, as I told you, 10 साल लग जाते हैं आराम से. Asset allocation should be 80-20. Out of 80 risk assets, at least 30 should be long-term allocation. That is what I feel. So the starting point should be long-term allocation. There are various filtration processes and various things. अभी तो बहुत सारा चीज है. तभी कुछ था नहीं, तभी खुद बैठ के annual report निकाल के देखना पड़ता था. I have been in phases where my desk is 4 feet 5 feet के annual reports है and ढूंढने को time लग रहा है. Now there is data, there is screener, free में सब कुछ मिल रहा है. So you have a certain criteria based on which you filter the stocks and you decide what to invest for long term. At least 30% long-term allocation. You start with long-term and then slowly and gradually reduce your time frame. Try to trade in the short term with a small capital. Don't do book trading. Real पैसा लगाओ, real पैसा से try करते जाओ, trial and error करते जाओ. करते, as I told you, I have been trained under, formally, informally, under not less than 25-30 people. But the best teacher has been my own experience, my own trading journey. तो मैंने लिया तो क्यों लिया, बेचा तो क्यों बेचा, स्टॉप लॉस लगाया तो क्यों लगाया, होल्ड किया तो क्यों किया. Even if I bent my rules, why did I bend my rules? Everything is journaled, and that journal, if I see my journal 3 years back, I just hit myself on the head and I see कि oh my god यार, ये मैं सीख चुका हूँ और फिर भी अभी इम्प्लीमेंट नहीं कर. और एट द सेम टाइम ऐसे भी होता है कि मैं ये करता था, ये करके मैं फंड मैनेज करता था और मैं पैसा भी कमाता था. ये क्या बात हुई? So lot of things, your trade journal will teach you everything basically. Talking about safe haven assets, for Indians, gold and silver are the best safe haven assets, obviously. I would put PSU mining stocks also in the safe haven category because they give at least 4-5% dividend yield आ जाता है और 2-4% से भाव बढ़ी जाता है, तो 10-12% मिल जाता है शांति से, right? From compounding perspective, one should only own 2 homes, only 2 homes. दूसरा भी, अगर आपको डर है आपके बच्चे आपको घर से निकाल देंगे, तो इसलिए दूसरा, नहीं तो एक ही बहुत है, right? So office, shop, godowns, factories only if you have a certain business and that business requires you to own these things. The reason is very simple. Real estate is a very slow compounder. You put simple Excel लगा दो, आप देखो आपका घर का 20 साल पहले क्या भाव था जहां आप रुके हो, जहां आप रह रहे हो आज, 20 साल पहले क्या भाव था उस लोकेलिटी में और आज क्या भाव, and you the Excel will give you your answer. So real estate only you should invest in real estate only, according to me. Again, I reserve the right to be wrong, but only if you have a certain skill set or certain connects or certain, there are few people, me and who buy things in litigation, रुपए का चीज चार आना में लेते हैं, they do the litigation, they solve the litigation, and then they come and sell in the marketplace. So only when you are, or there is someone who's stuck with real estate, is not able to sell, and you do a down payment and buy it at a heavy discount and then try and trade that. Only if you have that kind of a skill set and capital, you should do real estate. Otherwise, simple Excel pe compounding formula dalo, you will understand real estate is only giving you peace of mind. It is not giving you returns. You just thinking that, okay, I've got this real estate, I've got this rental property, तो मुझे rental आ रहा है, so it's safe and secure. I would rather tell you to buy Brigade Enterprise, stock of Brigade Enterprise or Prestige Estates or a DLF, rather than buying, a real estate. Yeah.
So we do have one question by Bhavesh. So he says, he is looking to invest in multiples of 25,000 rupees
Okay.
in SIPs.
Right.
So should he choose fund managers like Deserve or look for personal fund managers?
Right. So 25,000 per month may investment advisors, choosing investment advisors is, I don't know. There are very few investment advisors who advise or who work on 25,000 per month ka karke khud invest karna, rather than an investment advisor would actually direct you to do an SIP or a mutual fund and invest that 25,000 rupees per month on a steady state basis. What I would rather suggest him to do, again, based on his interests and his, his capacity and the current job or a business, whatever he's doing, you can keep, maybe you can invest in a certain, through investment advisor or mutual fund, you can invest, and then you can, a part amount, maybe 25,000 में 15,000 उधर डाल दो, 10,000 महीने का इक्विटी मार्केट्स में डायरेक्ट डालो खुद, एंड वही स्टॉक्स में डालो जहां पे वो म्यूचुअल फंड इन्वेस्ट कर. So for example, you are buying a large cap fund, and the large cap fund is investing in Nifty 50 or Nifty 100. You, with your 10,000 rupees, you put 15,000 there. With your 10,000 rupees, you buy a Nifty 50 or a Nifty 100 stocks of your choice or whatever you can study. You put in money there, and then you compare the returns. So it is not competing with the mutual fund. It is to get yourself, give yourself learning experience. नुकसान कम होगा, और अगर आपको लग रहा है कि कुछ भी नहीं हो रहा है, आप गलत जा रहे हैं, तो the capital is very small and the नुकसान जो होगा वो छोटा होगा, तो कभी भी छोटे कैपिटल में नुकसान करना पड़ता है.
Thanks. So, just the way in the course, get financial freedom, if you're early in your career, focus on savings, focus on a bit of investments, will help in compounding to be able to get to financial freedom at a certain, decade, maybe 2 decades, depending on where you are. But if you are someone who inherits a family fortune, then for you to grow that wealth, you need a different strategy, a game plan, right? And everybody's situation is different. And so I think, if I may paraphrase Devang, it's basically make sure that you're choosing someone who has a game plan for your stage of life, or your amount of money, for your amount of growth, right? That you are looking for, with obviously a value match. So with that, this has been an awesome session. Can we please have quick reactions? There's a reaction button at the bottom. would love to get some feedback. Feel free to drop a comment or two so that it becomes a good feedback for Devang and for us as well. Devang, I have two major insights from this session. And the first one is your candidness and your ability to speak openly and get to the point, right? I think I really learned a lot where you were able to call a spade, right? And give and explain concepts and your contradictions based on your experience as it is, right? And not a lot of people do that. So I'm extremely grateful for that. The second bit of it is, we hope you get into this good problem like another Pune fund, which is, 7,000 crore, where do I deploy? You're early in your fund management journey. We wish you all the best. We hope to see you have this good problem that there's so much money, I don't know where to invest.
No,
I think it's a good problem to have.
I would rather like to, I mean, as of today, looking at the liquidity of the market and looking at the Nifty 500, I would probably stop at 100-150 crores and stop taking in funds altogether. If the liquidity by that time increases, it's a different story. But I would rather look at delivering 30%, 35% or 40% on 100 crore compared to delivering 15% on 1,000 crore.
Lovely. So guys, there's a small window of opportunity, right? The Gujarati in me has to come forward as well, right? Thanks a lot, Devang. You have a lovely week ahead. And again, a lot of gratitude to you. Rest of you, this is inspiration. This is knowledge. This is insights. All of this is pointless if you don't take action. You don't do the exercises that are there in the Get Financial Freedom course. Focus, or the main point, is to move one step, two steps closer towards financial freedom by taking action. So I hope you're able to do that. So we'll close up with that. Thanks a lot, Devang, again. And
thank you so much. Thank you everyone for having tolerated me. Thank you so much.
It was wonderful. Thank you.
And please, those of you who've not started, please start yoga, meditation, pranayama in whatever way you can. That will change your life.
Don't worry. We've got yoga courses and meditation courses from DASAR online at the fingertip of your phone.
Perfect.
A week from now. All right. So
wow.
We'll send that across to you.
Okay.
Thank you.
All right.
Thank you so much, Devang.